If you're struggling with smart money concepts and price action and can't figure out why, it's likely because you're unaware of the hidden truths behind inducement and liquidity. These two elements are essential in smart money trading, and mastering them is a must before you execute any trade. In this episode, we're uncovering the secrets behind inducement and liquidity traps, and we'll also walk you through how to steer clear of the liquidity and inducement setups that market makers constantly lay out to trap traders. So if that sounds like something you're into, make sure to hit the like button to show your support, and don't forget to subscribe if you're new. See you right after the intro. Welcome back, traders. Before we dive into the manipulation tactics and traps set by central banks and major financial institutions, you need to be able to identify potential inducement and liquidity zones in the market and fully understand their precise definitions. So guys, let's begin with the definition of inducement. Inducement takes place at a particular area or level in the market where traders are convinced it's the right moment to enter a trade based on their analysis and strategies, which is exactly what central banks and big institutions exploit to lure retail traders into their traps. What does that actually mean? Where do inducements usually show up? Most of the time, inducement is found at certain key levels and zones such as order blocks, support and resistance areas, swing highs and swing lows, and the long trend lines. So let's begin with the order block. As you already know, guys, order blocks are crucial refined supply and demand zones where price, upon reaching them, can potentially reverse its direction. Order blocks contain a concentration of buy and sell orders, making them key inducement areas where traders are drawn into the market and typically place their buy or sell orders to get triggered in. As you can see here, price breaks the recent market structure to the upside and forms this bullish order block where traders are looking to enter long positions by placing their buy orders. Since it's an area that pulls traders into the market, it's clear that price didn't respect this bullish order block, so it's not valid and fails smart money traders, which makes it an inducement. Again, there's another order block slightly lower, and as you can see, guys, price ignores this one too, making it invalid, so it's also an inducement like the previous one. Make sure to watch this video until the end, because I'll be showing you which order block is actually valid and safe to trade and which ones are just inducements you must avoid. So guys, the next common zones where inducement usually takes place are support and resistance levels. As you know, traders widely treat support and resistance as areas where price is expected to reverse and respect these levels each time it revisits them, so a lot of traders get pulled into the market at these zones. For instance, here's a major support area that price has bounced from multiple times, so traders enter the market every time price returns to this zone expecting it to push upward. They place their buy orders here and end up getting induced into the market, but as you can see, before moving up, price dipped lower and hit the stop losses of traders using this long wick who had buy positions at the support level. Price then quickly reversed and shot up. So guys, this is a textbook inducement, and it's a setup orchestrated by market makers. Swing highs and lows are key points on the chart that often act as inducements. As you know, guys, swing highs and swing lows are the most recent highest and lowest levels that price has touched, and especially on higher time frames like the daily chart, these levels carry more weight and price tends to respect them more often, which is why traders frequently get drawn into the market at these points. For example, here on the NZD dollar daily chart, we have this swing high as the most recent top and this point marked as the swing low. Most retail traders place their buy and sell orders around swing highs and lows, believing that price will respect these zones and reverse upon reaching them. As shown, price creates false breakouts around these areas and triggers the stop losses of both buyers and sellers. So guys, we classify these zones as inducements. Trend lines are the fourth element that often serve as inducements. A trend line is drawn above pivot highs or below pivot lows to indicate the current direction of price movement. Trend lines visually represent support and resistance across all time frames. Most retail traders view trend lines as potential entry signals and get pulled into the market when price either touches or breaks the prevailing trend line. For example, here's a trend line that price has touched twice, so retail traders would be induced to take a short position after seeing price react to the trend line on the third touch, or if price breaks through the trend line, traders would shift to long positions believing it's a breakout and the right moment to enter. This pattern keeps repeating in the market. Traders constantly interpret signals on the chart and place orders based on their analysis, thinking it's the correct time to act. How can inducement work in our favor? Inducement helps us pinpoint key market liquidity zones. Moreover, it allows us to align with market liquidity and secure profits rather than getting caught in the liquidity trap set by the market's major players. Now that we understand the fundamentals of inducement, let's shift our focus to liquidity. So what exactly is liquidity? Liquidity refers to money or significant counter orders that need to be executed. The market constantly seeks to tap into liquidity to generate momentum. In simpler terms, liquidity acts as the fuel of the market, which is essential and plays a crucial role in driving market movement. So where can we locate liquidity? Liquidity refers to areas on the chart where a significant amount of money is sitting, like stop losses and clusters of buy or sell orders, because when a trader gets stopped out, that capital is absorbed by the market. This setup is intentionally created by central banks or major financial institutions. They deliberately move the market to mislead traders into believing that they think they understand what's happening with price action, but in most cases those traders are mistaken and end up falling into traps, ultimately losing their capital. So to stay profitable in the financial markets and avoid major losses, we need to accurately recognize liquidity zones on the chart. We can typically spot liquidity beneath equal lows and swing lows, above equal highs and swing highs, below or above dynamic trend lines or channels, and around order blocks. Now we've covered the fundamentals of both liquidity and inducement. So what separates liquidity from inducement? Liquidity removes traders from the market by targeting their stop losses, while inducement lures traders into the market and leads them directly into traps set by market makers. We've already covered both concepts and now we hold crucial insights about them. Next, I'll walk you through how to apply inducement and liquidity in your trading strategy to avoid falling into market makers' traps and to minimize your potential losses. So here we're looking at a schematic illustration that reflects typical price action behavior. As you can see, the market is trending downward. Price reacts to this zone and then resumes its movement lower. Notice how price is driven downward but fails to break the previous structure. Following that, it forms a minor retracement upward. Once the market gathers sufficient momentum, price drives down again and breaks structure right here. Now we're left with this untouched zone where price could potentially reverse. We also have another fresh zone right here formed by the recent break of structure. Many smart money concept traders, ICT followers and retail participants often get puzzled here and aren't sure which zone provides the safer trade setup. As we've mentioned earlier, inducements are specific areas on the chart orchestrated by large institutions like central banks and big players to lure in retail participants by prompting them to enter long or short trades and ultimately generate more liquidity for themselves. So in our case, this zone serves as an inducement level because you can clearly see that price attempted to approach the higher zone but instead dropped sharply before even reaching it and broke the recent low. What typically happens in this kind of setup is market makers entice a portion of smart money concept and retail traders to open sell positions right as price interacts with this inducement area. Continuing the move, you can see price climbs back up, touches the inducement level and briefly rejects from it. This minor rejection often excites traders and convinces them that price will move in their favor further. This small move attracts even more action-based traders to jump in by placing short entries with their stops positioned above the double top. Now, as illustrated, this manipulation strategy executed by market participants has stacked a lot of liquidity directly beneath our initial untested zone, and as we know, the market seeks out liquidity to fuel its movement. So here price returns to that first untouched zone, clears out the liquidity and resumes its dominant trend to the downside. This scenario demonstrates how large financial institutions manipulate market behavior to mislead retail traders, force them out of positions and capture their capital. To help you grasp this concept even better, let's go over another schematic example. Once again, we're looking at a bearish market structure. The price forms a new low following a retracement, then breaks structure to the downside. We can also clearly spot an untouched supply zone here and a double top formation above, which creates a strong liquidity pocket. As we've discussed before, this kind of equal high structure builds up liquidity just above those highs, and eventually the price will look to sweep that liquidity in order to mitigate the nearby order block. Now, since this double top also serves as a resistance level, many retail traders see this as a signal to short the market, expecting further downward movement. As we continue, we would typically expect price to run the stops sitting above the double top and tap into the supply zone. However, what actually happens is different. Price respects the lower unmitigated zone and continues downward without sweeping the liquidity above the equal highs. This is where most traders start questioning the move, wondering why price skipped the liquidity grab. The answer is we never know exactly when price will come for the liquidity. It could happen within the next hour or it might take weeks, but eventually the market will target those resting orders. Therefore, it's essential not to place trades directly beneath areas where major liquidity pools lie, because price will ultimately come back for them. In this example, after price tapped the first zone, it continued lower and caused a fresh break of structure that gave us a new supply zone, which some traders might see as a potential selling point. This zone becomes an inducement area in my view, since it was formed from a break of structure and shows imbalance during the move down, and smart money concept or ICT based traders are likely eyeing this area for short entries. However, most of of them overlook the larger picture. They forget that there's still an unmitigated zone higher up and a liquidity pool sitting just above that area. Also, there's a trend line in play here, and when price touches this line, many retail and price action traders will enter short positions, adding more liquidity to the top side. This trend line now serves as a magnet for price because of the liquidity building above it. This inducement zone is very convincing to retail traders. It seems technically sound for selling, and market makers are fully aware of this. They anticipate the setups and thought processes of these traders and design traps accordingly. So from our perspective, this inducement zone is a no-trade zone. We must avoid it at all costs. As the market shows a minor rejection from the inducement level, it lures traders into shorts, then sharply reverses, runs up to the true supply zone, sweeps all the liquidity including stop losses of traders who sold from the inducement area, and finally continues the original bearish trend. This example once again illustrates how market makers manipulate order flow to deceive uninformed traders and absorb their capital. Now let's move forward and look at another scenario that frequently plays out in live markets. As shown on the left side of the schematic, the market is in a clear downtrend respecting a descending channel multiple times. After forming a new lower low, price reacts to a significant bullish order block and shifts direction upward, heading toward the top boundary of the channel. This move creates what we recognize as an inducement level. At this point, it's very likely that many retail traders, especially those who trade based on chart patterns, will anticipate a reversal and open short positions right at the touch of the channel's upper line. They'll also typically place their stop losses just above that area, forming a visible liquidity pool. And as we've covered before, market makers always aim to target and sweep such liquidity zones. So in this scenario, price continues pushing up, breaking through structure and even violating the upper boundary of the channel. This move triggers stop losses of those premature sellers and injects momentum into the move. At this point, the break of the trend line excites many traders who now start opening aggressive long positions, believing a bullish breakout is underway. This is where inducement occurs on both sides. First, sellers are trapped at the channel top, then buyers are induced into the breakout move. This kind of price behavior repeats consistently across all markets, and it's a strategic move by market makers to trap liquidity in the next phase. Some traders enter long positions on a minor pullback, expecting the trend to continue upward. Price does push higher for a while and forms a temporary ascending trend line. However, shortly after, price aggressively reverses, breaking the trend line and sweeping the liquidity below this structure. This sweep targets the stop losses of traders who were chasing the move upward during the temporary bullish structure. Following this liquidity grab, price drops into a well-defined demand zone and after mitigation resumes its move to the upside. So in this single scenario, we see market makers induce both sell side and buy side participants, collect their liquidity, and then align the price movement with the institutional direction. This pattern of manipulation and realignment is something we must always be aware of in our trading strategy. Now let's move to a live chart to see how these mechanics unfold in real-time examples. We have Euro-Dollar 1 hour time frame here. As you can see, price changed its direction to the downside after the creation of this change of character. Here we have a break of structure, that price close below the recent lower low. Again here we have another break of structure. So guys, we are pretty sure now that the market is bearish. Next we have these equal highs here, which shows us the liquidity resting above there, and already we have this unmitigated order block here which is generated by a boss. We expect price to come back and hit and reverse from this zone. In fact, we are expecting price to come back and sweep the liquidity that accumulated above equal highs, and after touching the unmitigated order block continue to the downside. But as you can see, price went up and hit and reversed from this zone. The traders who try to trade from this level are totally wrong, even though they were lucky, because price reversed from this zone and pushed lower. As you know guys, price always wants to sweep the liquidity, so in this case anyone that is trying to trade from this zone already has ignored the liquidity zone here, which is created by recent equal lows. The lucky traders who had short positions from here look to find an opportunity to enter a short position from this order block that is generated by recent boss. But this level is an inducement level because based on smart money basics, this zone seems a very good and safe level to go short, because first, it's an unmitigated order block, and second, the price already has reversed from this zone in the recent past. Many SMC traders who did not understand the liquidity and inducement topics, they get induced into the market and place their sell orders in this area, and they also disregard the liquidity zones that are resting on the chart. But as you can see guys, price pushed upside, and after sweeping the trendline liquidity created by retail traders' stop losses and also sweeping the liquidity of inducement level which is created by SMC traders, finally reached this unmitigated order block, and after sweeping the liquidity of equal highs rapidly reversed to the downside. That's a traders. If you enjoyed the video and want us to keep making more videos week after week, please be sure to click the subscribe button and turn on the notifications bell, and also in the comments section let us know your opinions and tell us what kind of topics you want us to cover, and we'll work our best to create more videos for you. So thanks for watching, and we will see you in the next episode.